Today, we're going to completely flip your trading mindset. We are taking you from an emotionally driven gambler to a cold, calculated risk manager. Whether you're a beginner just trying to survive that brutal learning curve, or a seasoned trader looking for real consistency, what we're covering today is absolutely going to change how you interact with the financial markets. Okay, let's kick things off with a pretty tough question. Have you ever let a painful loss push you into the dangerous cycle of revenge trading? You take a hit, the frustration boils over, and instead of taking a breather, you immediately jump back in with a bigger position, just desperate to win it back. Look, if you've done this, you're not alone, but data shows this is literally the #1 account killer out there. There's this brilliant quote from the pros that really hits the nail on the head. If you can't sleep at night thinking about your open position, you're risking too much. It's so true, right? Anxiety, fear, tossing and turning, those aren't just normal side effects of trading. They are biological alarm bells. They're telling you that your risk parameters are fundamentally broken and you're betting way beyond a safe limit. So here is our roadmap for today. We'll be breaking down capital preservation, professional risk management, risk to reward ratios, the pin bar strategy, and finally, psychological recovery. Let's jump right into section 1, capital preservation and surviving that learning curve. Now, the absolute gold standard for institutions to protect their accounts from total ruin is the 1% rule. Professional traders, no matter how confident they are in a setup, rarely risk more than 1% of their total capital on a single trade. The logic is brilliantly simple. Mathematically, it means you could endure a brutal losing streak of 10 trades in a row and still have 90% of your capital intact. It keeps you safely in the game. Let's break down the math on this. Say you're working with a $10,000 account. Risking 1% means capping your maximum loss at exactly $100 per trade. If your strategy calls for a 50 pip stop loss, you just adjust your position size to exactly too many lots to match that $100 risk. This is exactly how you neutralize fear. You already know your absolute worst case scenario before you even click the buy button. Alright, moving on to section 2, professional risk management and the systems used by market veterans. So the stark contrast here is pretty mind-blowing. Emotional trading is all about gut feelings, random position sizes based on how confident you feel, and operating with zero safety nets. Professional trading, on the other hand, is defined by cold, hard discipline. It means strict 1% risk, data-driven entries, and, crucially, always using automatic stop losses to completely remove human panic from the equation. To stop the bleeding before it even starts, the pros implement non-negotiable risk protocols. A massive one is the maximum daily loss limit. Think of it as a psychological circuit breaker. If your limit is 2% and you hit it, your trading platform gets closed, period. You walk away. This single rule stops a bad morning from turning into an account-destroying afternoon. Next up is section 3, the risk to reward ratio, the mathematical engine of sustainable trading. The math here completely shatters conventional wisdom about winning. Consider trader A, who wins 60% of the time. Sounds great, right? But they risk $200 just to make $150. After 20 trades, they're only up $200. Now look at trader B. They actually lose most of the time, only a 40% win rate. But because they maintain a strict 2-to-1 reward ratio, risking $200 to make $400, they pull in 4 times the overall profit of trader A after the exact same number of trades. It's not about how often you win, it's about how much you make when you're right and how little you lose when you're wrong. With our defensive shields up, let's dive into section 4, the pin bar strategy, which is basically your tactical sword. So what exactly is a pin bar? It's a highly accurate reversal indicator. You can spot it by its small real body and a super long tail or wick that makes up at least 2/3 of the entire candle. But what's the story here? It visually shows us that the market pushed price to an extreme, but was aggressively rejected by an opposing wave of buyers or sellers. It is a literal footprint of momentum shifting. Here is your straightforward 3-step execution plan. Step 1, wait for that pin bar to form right at a key support or resistance level. Step 2, only enter the trade after the candle has fully closed to confirm the pattern. And step 3, this is absolutely crucial, anchor your automatic stop loss safely beyond the extreme tip of that long wick. If the price breaks past that wick, the setup is busted, and your auto stop loss gets you out with minimal damage. Finally, let's tackle Section 5, Psychological Recovery and Mastering Your Own Mind. It is terrifying how fast a single loss can trigger a massive downward spiral. At minute 0, you take a big hit. By minute 1, your brain gets flooded with cortisol, triggering your amygdala, your fear center. Frustration totally takes over. By minute 2, logic is gone, and you impulsively jump back in with a heavier position to get your money back. This biological panic is the silent killer of trading accounts. The absolute key to breaking this cycle is cognitive reframing. Amateurs view a losing trade as a personal failure, a direct attack on their ego, which makes trading incredibly stressful. Professionals, they are wired completely differently. They see a loss simply as an expected business cost. Just like a restaurant expects some food spoilage, a pro accepts small, calculated losses as the necessary operating cost of finding the big winners. When tilt sets in and emotions run high, you need mechanical rules to save you from yourself. Experts swear by the 3-loss rule. 3 consecutive losses, you are mandated to step away from the screen. This isn't just about taking a break. It physically allows your physiological cortisol levels to normalize. Later, when you're genuinely calm, you can objectively analyze your trading journal to see if the market shifted or if you just temporarily lost your edge. I'm going to leave you with this final, powerful thought. True discipline is not about avoiding losses entirely. That's honestly impossible. It's about executing your plan flawlessly, managing your risk, and knowing exactly how to lose like a seasoned professional. So the next time the market turns against you, will you react like a cornered gambler, or will you execute like a pro? The choice and your capital is entirely in your hands. Understanding supply and demand. Let's break down these 2 core concepts. A demand zone, it's basically a floor. It's where buyers previously stepped into the market super aggressively and forced the price higher, so it acts as potential support. On the flip side, a supply zone is like a ceiling. This is where sellers took total control, forced everyone to accept lower prices, and pushed the market down. It acts as resistance. But here's the absolutely crucial secret. Markets actually remember these zones. When the price eventually revisits them, those exact same aggressive players will often step right back in. Now you might be wondering, how do we actually know they were aggressive? Well, we look at the volume footprint. These aren't just random arbitrary shapes on your screen. They are the literal footprints of big money. This footprint shows us exactly how much buying and selling happened at a very specific price level inside a single candle. If buyers are just totally overpowering the sellers, we're going to see massive volume on the buying side. It is the undeniable internal record of that tug of war we talked about.